New tax law signed. This changes everything for retirees over 65. Hey, my Social Security family, welcome back to Seniors Relief. This channel is here to keep you one step ahead, not catching up late. I break down the latest Social Security updates, SSA payment changes, SNAP and EBT benefits, IRS announcements, stimulus news, and government programs in simple words so you clearly understand what affects your money. Many people only hear about these changes after the deadline passes or payments are missed. But viewers here know early and know exactly what to do. So subscribe now, stay informed, and make sure you're always among the first to hear about new payments, benefit increases, and eligibility changes that could put money in your pocket. The new tax law has officially been signed, and for retirees, this is more than just a headline. It's potentially life-changing. If you're thinking about your retirement plan, your savings, and how to generate income that lasts, taxes need to be front and center in your strategy. It's not just about how much you've saved or how diversified your portfolio is. It's about how efficiently you manage those resources from a tax perspective. Failing to plan strategically could mean leaving tens of thousands of dollars on the table over the course of your retirement, money that could otherwise go toward travel, family, healthcare, or simply creating greater financial peace of mind. The reality is that taxes are often one of the largest, most predictable expenses in retirement, yet they're one of the easiest to manage if you take action early. What's important right now is recognizing that this new law opens a specific window of opportunity that won't last forever. We're looking at a 4-year period from 2025 through 2028 where certain provisions can be leveraged in ways that could meaningfully reduce your lifetime tax bill. Some elements of the legislation are permanent, which is excellent news because it removes a lot of the uncertainty that has hung over retirement planning for years. Lower tax brackets and an increased standard deduction are now set in stone, meaning you can plan around them with confidence. However, other features, like the new senior bonus deduction and expanded SALT deduction limits, are temporary. That means the next 4 years could be the best, and maybe the last, chance to take full advantage of these changes. This is not the time to adopt a "I'll deal with it later" mindset because, as we know, eventually can quickly turn into too late. Before diving deeper, it's worth noting that the right strategy starts with understanding the fundamentals of your retirement portfolio and how taxes interact with it. I've created a free guide called the One Critical Portfolio Shift You Must Make Before Retirement, which explains how to structure your portfolio to avoid sequence of returns risk and make your savings last. Even if you've saved diligently and built a strong portfolio, entering retirement with the wrong strategy can compromise your plan. With withdrawals taken at the wrong time or in the wrong sequence, market downturns can erode your nest egg faster than anticipated. This guide walks you through how to protect your portfolio, make withdrawals smarter, and maintain both confidence and clarity in your retirement income strategy. You can access it using the link in the description, and I highly recommend taking a look before making any moves. The new tax law covers a lot of ground, and there are numerous provisions worth knowing about, from expanded child tax credits that affect families, to changes in charitable giving rules, to temporary deductions for auto loan interest. The expanded SALT deduction cap, for example, could be very meaningful for retirees in high-tax states like California, New York, or New Jersey, potentially saving thousands in taxes. But for today's discussion, I want to focus on what I see as the biggest planning opportunity for retirees: the enhanced standard deduction and the new senior bonus deduction. These are the provisions that can make the most direct, immediate, and long-term impact on your retirement plan. The most significant permanent change in the law is that lower tax brackets and a larger standard deduction are now locked in. This is rare in tax policy, where temporary rules and sunset clauses are the norm. Until now, many of us were planning around the assumption that the 2017 tax cuts would expire at the end of 2025, which would have meant higher rates and lower deductions for most Americans. With this uncertainty removed, retirees can finally plan with confidence. The standard deduction will continue to adjust for inflation, preventing bracket creep and helping preserve your tax-free income over time. This is crucial because the standard deduction essentially establishes a tax-free zone, a portion of your income that you don't have to pay federal income tax on, automatically and without any complex paperwork. For retirees, this deduction forms the foundation of a tax-efficient income strategy. Understanding how the standard deduction works requires looking at the tax formula itself. You start with total income. This includes wages if you're still working, Social Security benefits, pensions, IRA distributions, dividends, interest, capital gains, rental income, and any other sources of income. From there, you subtract above-the-line deductions like contributions to a traditional IRA or HSA, student loan interest, or educator expenses if applicable. What remains is your adjusted gross income, or AGI, which is pivotal because many tax credits, deductions, and even the taxation of Social Security are tied directly to this number. Next, you subtract either itemized deductions or the standard deduction, whichever is higher, to arrive at taxable income, the figure used to calculate federal income tax owed. For most retirees, especially once mortgages are paid off, the standard deduction will likely be the most beneficial choice. Starting in 2025, the standard deduction is set to increase by $1,500 for joint filers and $750 for single filers, bringing it to $31,500 for a married couple filing jointly and $15,000 for single filers, on top of annual inflation adjustments. For those over 65, an additional deduction applies, $1,600 per qualifying spouse for married couples and $2,000 for singles. This means a retired couple over 65 could see a combined standard deduction of $34,700, effectively shielding nearly $35,000 of income from federal taxes before considering other credits or deductions. That's real, tangible relief and a significant planning lever. But the most compelling new feature is the senior bonus deduction, which starts in 2025 and lasts through 2028. This allows an additional $6,000 deduction per qualifying individual over 65, stacking on top of the standard deduction. For a married couple over 65, that's an extra $12,000, bringing their total potential standard deduction to $46,700. This deduction applies regardless of whether you itemize or not, which means retirees who take the standard deduction get this bonus automatically. It's an unprecedented opportunity to shield a substantial portion of income from federal taxes. However, there are limits. The deduction begins to phase out at $75,000 for single filers and $150,000 for married couples filing jointly, meaning high-income retirees will see a reduced benefit. Planning around these thresholds is critical, whether through income timing, strategic withdrawals, or Roth conversions. Speaking of Roth conversions, this 4-year window offers a unique chance to convert traditional IRA funds to Roth IRAs with little or no federal tax impact. For example, a couple over 65 with a total standard deduction and senior bonus of $46,700 could convert that same amount from a traditional IRA to a Roth and pay no federal income tax. That converted money then grows tax-free and doesn't count toward future required minimum distributions, providing long-term flexibility and control. Likewise, retirees with appreciated assets in taxable accounts could harvest gains now, potentially paying zero tax on those gains while resetting their cost basis for the future. It's essentially a strategic reset that maximizes the tax efficiency of your portfolio. The key takeaway is that the next 4 years are not a time to be passive. Strategic, thoughtful action now could reduce your lifetime tax bill dramatically. This doesn't mean taking risky or drastic steps. It means planning intentionally, coordinating withdrawals, managing income timing, and leveraging deductions strategically. Think of it like shopping during a big sale. You're buying something you will need anyway, just at the most favorable price. Once 2028 passes, this window will close, and there's no guarantee it will open again. Retirees who fail to plan may look back and wish they had used this rare opportunity to optimize their tax situation. Taxes can be intimidating, but in this case, careful planning over the next 4 years can create massive advantages with relatively straightforward steps. Fundamental retirement tax planning, understanding deductions, income brackets, and strategic withdrawals can make a huge difference, and it doesn't require complicated or exotic strategies. If you haven't already, now is the time to review your plan with an advisor, ensure your portfolio is positioned for retirement distributions, and take advantage of the enhanced standard deduction and senior bonus. And don't forget to download my free guide, which complements this tax strategy by showing you how to structure your portfolio for sustainable withdrawals, confidence, and long-term security. Combining the right tax strategy with a properly designed portfolio is how you maximize your retirement income and peace of mind.